Let me answer Fernando's question first. Fernando says, is there any option strategy that allows you to profit after the earning has been released? Yeah. If you know the direction and the direction's going to hold, just pick a trade that matches that direction. I don't mean it to sound simple like that, but a lot of times you just have to look at the stock chart there, Fernando, and say, okay, usually when a stock has a positive spring up after an earnings, what happens after that? Does it go up or does it go down? Does it follow the trend? Does it hesitate? Does it pull back? There's no one strategy because it's going to depend on what the stock does long term. All right, let me go to 2 years on Goose. Now we're going to assume that every big movement is the earnings, and I know that this one is. Okay, so here, stock was trading at around $46, $48, and the earnings drove it up to, it opened at about 58 on the earnings. Okay, so you had about a 13-point move on a $42 stock. And then over the next 5 days, it continued to move. So after the earnings, yeah, sure, I could buy a straddle if I expected it to keep moving, but I wasn't sure, or a straddle or strangle. Would I sell at this point? Very risky, because what happens? In a couple of days, it's right back down below where it jumped up to. But then it comes back up, and then it goes back down. So what I'm seeing with this type of chart, and here's another earnings bounce, of course, you can see. It goes not too much, 55 up to 70. It's another good move. And then just had a straight decline. Well, this is, you know what this is? This is that October, December 2018, I believe. Here's another disastrous earnings the other way. What happened after it? Well, it started to recover. So I'm saying that stocks always go up or always continue the trend, or maybe go up after the earnings and hesitate and then continue to go up? No. Am I saying every time there's a drop, the stocks continue to go up? No, a lot of times they continue to go down. So there's no one strategy, Fernando. You've just got to play based on what was in the earnings report that caused it to move one direction or the other. How is that going to affect it long term? And then decide how you're going to structure your profit and loss chart of a particular strategy in order to get there. Okay? There's no one answer to that question, because every stock is different how it reacts after earnings, whether it's positive, whether it's negative, whether it was negative earnings with a positive outlook or positive earnings with a negative outlook, and they're all different based on market sentiment, based on what's going on in the industry, what's going on in the sector. I think I mentioned buying straddles and strangles after the earnings mainly because what happens after the earnings, unless it declines sharply, is one of those ones that had a 33 or 40% drop because of really poor earnings. In most cases, volatility, implied volatility, was building up to that event. Now the events happen and the volatility dries up, with the exception of those that drop 30 or 40%, 33% or so, 35% after an earnings. The volatility might actually increase. But why do I bring that up? Because when the implied volatility drops after an earnings, there's a volatility crush after the earnings, that might be a good time to buy a strangle to see, well, is it going to go up or down from here? Because you're paying into lower implied volatility at that point, once everything settles down. But yeah, you're going to have to track the direction on that. Okay. All right. So I'm going to I did actually accidentally click a button to rechange the order. So I'm just going to take Guy's question right now. Guy wants to know, is it okay to enter a married put on an existing stock that you own? If so, what put option do you buy if you're entering an existing position, the current price or the price that you originally bought the stock? That depends on the situation, Guy. So Guy's talking about a married put position, protecting the stock, and he's asking, now that he's seen some of the write-ups on married puts and he's been trading some of the married puts, if he just owns the stock, if he was going to buy a put option today, what would he base it on? Okay, well, there's two thoughts on that. Number one, if I own a stock, say URI, which is at 135, and let's say I bought it at 116 a few months ago. Well, what I'm going to do is I'm going to go into Power Options and I'm going to go into the Insurance tool. And yes, I'm buying a put likely based on where it is now, but this tool is going to show me which puts will give me the most locked-in profit depending on my expectations. So I'm going to say URI, my cost base is 116, and I'm going to leave it at all expirations for this exercise. And the reason I'm leaving it at all expirations is it's going to show us that we have an unrealized 16.7% gain in URI at this point, currently trading at 135.38. The short-term November 15 put, 21 days to expiration, 136, with a price of 420, would give me the highest locked-in profit of 13%. What does that mean? It means that I own stock at 116, I'm paying 420, my new cost is 120.20, but this is a 136 strike put. So I'm guaranteed in the worst case scenario to make 1580 and still have unlimited upside. I'm 13% bulletproof status. No risk on the position going forward. Okay, so let's just take a look at the profit and loss chart there. All right. That's what bulletproof means. I'm above the red line. There's no potential for loss. Even if the stock fell back down to 80, I am guaranteed to get 136 back, a profit of 1580. But if the stock continues to go up, I still have potential for more profit. But again, what's the problem with this guy? This is only 21 days out in time. If I have earnings coming up, absolutely, I'm buying the shorter term put on this right now, locking in 13%. And if the stock jumps 12% or 15% on earnings, hey, guess what? I'm still going to take advantage of that upside. But if you wanted to go further out in time, which I would prefer that you do, I'm going to go to the first series I see that's close to 150 days. In this case, it's March. Now, I'm going several months out in time, following the rules in the blueprint for radioactive trading. And again, as we discussed a little while ago in the previous section here, that when I'm buying, I want to be buying further out in time because it's less cost per day. But in any case, let's go to March 2020. And yeah, it shows me that these 160 puts here would give me the most locked-in profit, 11.4%. But think about your rules of the married put that exist in the blueprint. Would I ever go that deep in the money? No. I'm probably going to maybe the 140. I still want to follow that rule, just go maybe one strike above the current price. This is only giving me a 7.5% locked-in profit, but that's because I'm going 6 times the amount out in time. Right, from 7 times, from 21 days out to 147. So I'm giving up some of that locked-in profit because I'm paying $14.25 in this case for the 140 instead of $4.20 for the 136, expires in 21 days. But I still have a guaranteed profit of $9.75 and 5 months to continue to do other income methods and adjustments on this position. Okay, so that's what you'd use. If you have a gain, use the insurance tool, set your time frame of how long you expect to be holding the stock. I'd like to still go at 140, 150, maybe 200 days out in time as I would with a standard married put. But if I've got an unrealized gain, I can lock in a lot of that unrealized gain there, have a bulletproof position going forward, still be able to trade it with other income methods to continue to increase this bulletproof status, lower cost basis, and increase profits. On the other end of that spectrum, if, for example, I bought URI at 156 and the stock is now down, what I would consider doing is still buying a put to limit further losses and to have some control to the downside. Already I've given up, 21 points on this one. It's an extreme example. But I would still do the same thing. I'd probably go out to March or maybe to June, 147 to 238 days out in time. But I'm going to base my put selection on if I was just opening a new married put right now. If I was buying the stock at 136, I'd probably be looking at the 140 or the 145. I'm going to take the 145. Now, I know and this is the opposite. I'm sort of locking in $11 of loss already with a potential for more loss because of the time premium. We should probably be at about 14, 15%. All right, 16.3, okay? So why would I ever do this? Well, I'm near the stock price. Even though I have a loss in the stock, I've capped it now, so I can't lose, I'm not at the full loss yet, but I can't lose more than 16.3% on this position. And I can still treat it as married put. So if the stock comes back up above 146, 147, I could make an adjustment to this put, sell some of the premium, do some of the other income methods, and start whittling away at this risk and still keeping a relative break even. Another example that you could use, which doesn't cover the downside, of course, but can help you get back to break even faster, is our stock repair tool. This is the one that looks at a ratio call spread to help you get back to break even. Just put in your cost per share and your number of shares. And then what it does is tries to build a ratio spread. So again, this one is unfortunate because with my cost basis, I can only go out to the closest repairs out to March. Usually you should only do a stock repair if it's in the next 60 to 70 days, somewhere underneath of that. But yeah, this one, what it would do is build a sort of ratio repair position for you. Oops, sorry. What in the world is that? Sorry, folks. Google's getting invasive there and telling me that, hey, I kept this screen off of your screen. Why, thank you, but I wanted it on my screen. Okay, so I'd buy a 135 for March and sell two 145s for a small net credit there, about $3. It lowers my break even down to 143.85. And if in March the stock's trading at 145, I could make 1.5%. Now, keep in mind that's still 11 points away from my cost basis. What we've done is do a bull call debit spread with an extra covered call. So that's the stock repair. It doesn't protect the downside, though. It just helps you get back to break even faster as well. Okay, so that's one of those there. Okay. The put's based on the current price, but the insurance tool is easy if you have a gain in there, Guy, because that shows you directly what your new return would be, your new locked-in profit in that scenario. It's doing the math for you. If I have a stock that's down, I don't want to base it on the 156. You know, I bought the stock at 156. It's now trading at 135. I'm not going to buy the 160. That's going to be, number one, too expensive, and it's going to really increase that upper cost basis. I'm going to keep it down here, even though that means I'm taking a maximum loss of 16%, because right now I'm already a loss of 14%. Okay, I'm trying to rebuild it with some protection in place so I don't let it get to 20, 25, 26% or more. Okay. All right, so let's see here. All right, I think it was Martin was next. I did answer Fernando's question. I'm just scrolling through here. Okay. Oh, I'm sorry, Randall. I wanted to get to Randall's question since we've been talking about this. Randall says, Mike, do you personally trade vertical spreads a lot? I wouldn't say a lot. I do about 2 to 3 vertical spreads every 2 weeks, so 2-week out cycle. You said, if so, do you ever try to come up with delta ratio? I'm sorry, delta ratio, long option delta versus short options delta prior to opening a trade? Absolutely not. Don't mean it to say that that's a bad thing. To me, the delta ratio is only important in diagonal spreads, calendar spreads, and more. I don't think the delta ratio is important for vertical spreads that have the same expiration, debit spreads, credit spreads, or iron condors. I never look at the delta ratio for the vertical types of spreads where they have the same expiration date. I'm more focused on 3 factors. The return that I need to match my trading goals with the success rate that I average, looking for about an 85% probability or higher, while still averaging around a 14, 15% potential max return. So I'm looking at the probability, time frame of just about 2 weeks out in time, return around 13, 14, 15% on average, and I want stocks definitely that follow the trend. Gamma, theta, implied volatility ratio of the sell option and the buy option, delta ratio. I don't think it needs to get that involved for vertical spreads. Anyone has any thoughts on that or have been using that filter and have had more success than they did without using that filter? I would love to hear it. But in my experience, in all the back testing I've done for the bull puts and the bear calls that I've done, things such as put call ratio, delta ratio, gamma hedging, or screening specifically for higher implied volatility actually worsened the results over time. The average return almost doubled, but the number of losers actually increased for the looking for higher implied volatility. So I have not seen that in my testing or in my actual trading for that to be of any benefit. It is an extreme benefit when talking about diagonal spreads, double diagonals, and things of that nature, where you're buying an option that's 2 to 3 months out in time and then selling a 1 week or 2 week against it, or buying 6 months out in time and selling a monthly against it. That's where the delta ratio really comes into play, because if you think about it, what you're trying to do is simulate stock ownership with a long call that you're buying So you don't have to pay the full price of the stock and you're still selling the same strike against it. But you want the long option and the diagonal spread there to be at a good delta. You want it probably around 0.7 or 0.8 perhaps, maybe 0.65, 0.7, 0.75. But I still want a good delta ratio in that case. So when the stock does move up, I want to make sure that I'm making maybe 2 to 1 or 3 to 1 on my long option as compared to what I'm losing on my short option, which also has its own tricks because when you get within the last couple days to expiration of your short option is going faster to a delta of 1 and your long option is not increasing anymore. That's just the nature of it. So that short option is either going to go to 0 or to a delta of 1 as well. Okay. Now, Sam just made a comment, and it goes directly to sort of Martin's comments. Martin had commented earlier here. He had said, sorry, Martin, said the VIX is now below 12. Oh, and by the way, that was a fantastic question. Any question you ask, anyone asks about what criteria would make a better spread or would do that, that is an excellent question to ask. I just don't feel, and we make it available, but I just don't feel that the delta ratio is an important structure for the credit spreads. And one of the reasons why, and I alluded to it in the discussion we just talked about, but remember, in a diagonal spread, my investment is the long option. I'm just using the short option to lower this cost basis and lower this cost basis, and I'm going to be in this for a couple months. In a standard vertical spread, I hate to say it this way, but I don't really give a damn about the long option whatsoever. Okay? The long option is there to control my margin. The long option is there in case stuff happens. All of my focus really is just on the short itself, the difference in strike prices to the net credit I can receive, which gives me what? The return. That was one of my 4 points. Where this short option is in relation to the stock price, that's my probability. And is it a good stock that matches the trend? Those are my stock criteria. That's my main focus. I don't think searching for a specific delta ratio in this vertical spread scenario, when my whole goal is to have everything expire worthless, by the way, I don't think a screening by a delta ratio say, oh, what if this is actually a 4-point spread instead of a 3, or a 3-point spread instead of a 2 because the delta ratio is better here. If the stock stays above here, the only reason a 3-point spread or a 4-point spread is going to be a better trade than the 2-point spread is because of higher net credit. You took the risk of higher margin to get a higher net credit, but you would have been a lower return. So I just prefer to stick with 2, 2.5, maybe 5-point spreads, focusing on the distance from the stock price, net credit and return coming in, and the probability. This, in a diagonal, is where the delta ratio matters. I really don't care about the long option and the vertical spread aside from it setting my margin requirement. Okay, that's really it. All right, and still getting the return I want. If I take a 2-point spread that has the return I want, say, hey, I can get a higher net credit if I go to a 10-point spread, I'm likely seeing much, much lower return than I would want. All right, VIX is not quite below 12 yet, but Martin's got a great point. The VIX is now below 12 or close to a bottom. What's a good trade to play the VIX for upside? Well, anything that you would do in a normal stock, Martin. But the best thing to probably do, and this is, I don't trade the VIX this way. You hear me mention, Martin, that I trade the VIX. I buy calls in the VIX around this point. Unfortunately, I bought them a day or so ago when it was at 1370 because that felt like a new lowish to me, the way VIX has been going. But I buy calls on the VIX that are maybe 30 to 45 days out in time, maybe only a few contracts, and all that's designed to do is hedge any losses I might take on the diagonal call spread portion of my portfolio, the bull put spread portion. If the market suddenly falls, VIX spikes up to 20. This gain on those long calls is using to hedge the losses I took there. I'm not playing this specifically for profit. But again, I can say, what is a good way to trade it? Well, if you think it's near a low, you could trade bull put credit spreads on it, but I guarantee you those puts might not have a great premium. Naturally, the answer you could say is just trade a long call on the VIX. Why? Because you think it's near a low, and sooner or later someone's going to open their mouth and say something silly. Someone's going to shoot a rocket into the Pacific. Someone's going to try something, test a new weapon, and volatility is going to spike. So what leaves the upside open but gives you a controlled risk? Well, that's going to be buying a call on the VIX, isn't it? Would I do a bear call spread on the VIX? No, not right now. The only time to do a bear call spread, of course, naturally, is if you're bearish, and probably be after a spike, and that's still risky because after the initial spike, it still could spike more. Remember, you can't buy securities on the VIX. You can't buy shares of the VIX. I'm sorry, Martin, is what I was going with that. So you lose the ideas of married puts. You lose the ideas of collar trades. You lose the ideas of others. This was leading me to what I was saying with Sam. He had commented, and of course, his comments on using UVXY. He buys UVXY before the market close, not because he's expecting the market drop, but any negative, it's going to hedge his gains. But he uses UVXY, buys shares of UVXY, because then he can trade it as a covered call, sell premium against it without the margin requirement. Things of that nature, okay? So that's another way you could look at it. Okay, so that's just the discussion there. So two factors I always have to bring up in this discussion. How would I trade the VIX? Well, I told you how I would trade it. I just use it as a portfolio hedge. I don't trade it to profit in general. If you think the VIX is at a low, what same option strategies would you use if you think a stock was a low and that it has to go back up? Those are the same strategies you'd likely trade here. Another advantage of using one of the VXXB, the volatility ETFs, UVXY, as Sam mentioned as well, is that the options in that case are actually based on something, meaning they perform more like standard securities. You have intrinsic value on those options, okay? And I'm sorry, you have intrinsic value on those options as well, meaning that if UVXY went up to a certain price, in that case, what would happen? Well, if it goes up 2 points, and your option was in the money and you had a delta of 0.8, you'd expect it to go up 160. VIX options are not like that. I could buy a 14 strike call on the VIX, and the VIX could jump up to 16. Doesn't mean my 14 call is going to be worth $2. It might only be worth $1.60. Because of the fact that it's based on the future projection. It's based on the futures prices for volatility, not on an underlying. Okay, not like a standard stock that has an underlying where you get intrinsic value. It could be beyond intrinsic value, absolutely, at times, depending on where things are. But remember, the VIX is based not on the price it is right now, but on the futures value of the VIX, whereas VXXB, UVXY, TVIX, Sam says, is also one that you could use, is also one. Another thing you could consider, of course, if you think VIX is going to bounce around, that you think it might go back up to 16 and 17 where it was recently, and then maybe pull back down here, you could probably do a straddle or a strangle on the VIX if it's not too expensive as well. So we could take that also into consideration. Yeah, I don't know where that comment was in the order, Sam, but you said it's like a contango. I think we were talking about that was related to the delta ratio and more. Okay, so let's see here. I'm not sure if, David, you had another question. David, if there is a comment you made or a question you posted that I did not get to, it might have been accidentally erased when I was going through the lists here. I've got Mark's question and Samir as well, it looks like. Okay. Okay. I'll take Samir first because we're getting close to the end. I will touch upon I will get to your question, Mark. Mark has an example of the earnings that Fernando answered. So Fernando, you might want to stay online. Okay, this is a question similar to maybe what David was answering. So Samir says, question. I bought a December 20th 22.5 call on KN. So the KN 12, 20, 22.5 call. Marijuana is dead at this stage. That's what Sam just commented. Okay, the stock value went up today, but the option price dropped more than 50%. What is my next move now? Okay, well, management, you could sell short-term calls against it, as we talked about with some of the diagonals, to try to hedge some of the loss you're taking on the KN call. Oops, sorry. If you think the stock itself is going to recover and continue up, you could buy more. Why did it drop 50% today? Well, as we were talking about earlier, I apologize, Samir, just sort of got some dust there. 22.5 call, 45 to 50, stock's down 47 cents, okay? 22.50, it's at 45. 5 cents roughly. That's the bid price if you sold to close it. So previous day. Oh, groovy. Yep, so it was at 110 yesterday with an implied volatility of 0.4393. 0.4393. Right around 21.57. It did drop for, what was your delta? Delta. I don't have it here, do I? Unless I'm staring. Oh, I want calls. I'm sorry. Let me go to calls only. Samir. That'll help us, won't it? All right. Ivy at close of yesterday, 0.4393. Good action. Implied volatility range has been 0.3011 to 0.6249. Delta. Sorry about that. 0.4. I can't imagine that changed too much, but let's go to current. You lost 50% of your value today because the implied volatility dropped from 0.4393 to 0.2965, which has now set the lower range of implied volatility. Delta did shift down to 0.318 from 0.44 with just a 47-cent movement on the stock, but that's also related to volatility. That's what happened on the position. What you need to do now is delve into why did that happen. Was there earnings today? Yep. So you had earnings coming in. So the event's over. Stock didn't really have any effect by it. It dropped 47 cents, so it must not have been that promising. It's only a 2% drop, which isn't bad. The good thing about this, Samir, is you've got time on your side. You can look at ways to manage it, sell premium against it based on where you expect the stock to be trading. You could sell maybe November 22.5 call, sort of create a calendar spread that would reduce some of your cost basis, probably not by 50 cents, where the volatility is now. We're probably talking about 20 cents or 30 cents in that case. Here's what you can do. For the sake of time, I don't have the time to go through it this weekend, Samir. Go to the webinars page, powerup.com/webinars.asp. That is a public page, and most of the webinars you can access here without even logging into your trial account or your subscription. Under the Option Strategies tab, there's a lot of videos here on bull put management, 8 ways to manage a bull put spread. I'm going to go further back in time. Managing your spread positions, how to be successful with spread trades, calendar spreads, yada, yada. So there it is. I'm sorry. Selection criteria for long options, managing your long options positions, management techniques for long calls and puts when the underlying security moves against you or moves in your desired direction. Yes, it's from 2015, but I felt it was a good polished webinar, and the fact that if I was presenting a new one today, it'd be 95% of the same content that I used in that position. So unless there's something I'm missing or a new idea came up, don't necessarily need to rehash it at this point. But again, that will help you out with some ideas on what you could do. You could probably even try, maybe there's a discussion in there about using that stock repair tool we looked at briefly for a long call position. You do have time. You're out to December, but KN only offers single expirations with that in that scenario. So we could do that also, okay? Okay, Samir, you're welcome, but take a look at that video, and then after you've watched the video, look at some of the ideas that are there, but then send me an email later on this weekend or give me a call during next week if you want to talk about some of the ideas as well. All right. Anyway, Mark says, I have an example of picking a direction after earnings. I held a calendar. Okay. I held a calendar on Amazon at 1775 October 25. Jot that down. 1775 10/25. Okay. November 1 costs 626. I got lost there. So the 177.5. Oh, for November 1 costs that with puts. After wild riding earnings, Amazon closed about $17.60. Calendar closed for about $14 for a gain of $7.25. Okay. Oh, so I want 1 week, 1 month, not 12 months. All right. Okay, so here's the thing. Okay, so he's saying that after earnings, all right, picking a direction after earnings, you held a calendar on Amazon at 1775. Okay. for November 1st expiration cost 626 with the puts. After a wild ride after earnings, Amazon closed about 1760. The calendar closed about 14. All right. So yeah, so he got the close here, but so I don't know if it opened here. So Mark, I'm not sure if you're saying that you opened this 1775 spread the day that the earnings started down and then it came back up. Was that the earnings even in that case? So when it went down, you did I don't know if you did a reverse calendar put or a standard calendar put, and so when it went up at the end of the day to 1760, and you said puts, it had a profit. Okay, that's kind of interesting. In that case, but that's what he said there in relation to that he's doing as well. So that was picking a directional there. I don't know, Mark. Yeah, we are at 6 o'clock, 6:02, so we're probably not gonna have time to cover it today. But if you can, Mark, email me the specifics of your trade, because if I'm reading you opened that calendar put at the open, and the stock moved up after the original rebuff of that and stayed sort of at a level. I don't know how the calendar put would have made money in that case, unless it was a reverse calendar put that was actually similar to a calendar call but done with puts. So I'm missing something. I'm going to be honest, I'm missing something there in that case. So go ahead there and send me an email later with the specifics of that calendar put spread. But that's something directional he was talking about in relation to Fernando, is that he played this one, the Amazon one, at the earnings for a directional trade using a diagonal spread, it sounds like, with puts on that position. So, okay, there we go. All right, you opened before earnings, guessing it would hold the price. Okay, you were expecting it to hold the price, and then it shot down and then shot back up. Okay, I see what you're saying, yeah. Okay, so yeah, the only problem I have with the calendars, using a calendar, of course, like that in that case, going into earnings, standard calendar spread position, diagonal calendar call or calendar put, is you've got a capped gain. And in some positions, you might actually, if there's a large gap up on a calendar call, I might be at this price. You expected it to hold its price, and it did have a little reaction there, but from where it was 5 days ago, it's almost in the same range, right? There's almost a null effect there of that earnings event. Even though the first 10, 15 minutes, 20 minutes of the market were probably very hectic, at the end of the day, it's right where it was in a sense. So it did kind of hold its price and did work out well for you, as you mentioned. I see, because it held its price. That's what your expectation was by the end of the day. All right. Okay, well, ladies and gentlemen, I think I got through all of the questions that were that came into us. Fortunately, we are at 6:05 p.m. Eastern Time. If you have any last-minute questions, you go ahead and send that in. I'll get time to address them, perhaps, or what I'll do is go ahead and I'll send you an email later in the weekend there. I just want to remind everyone, as always, that I am showing my screen, that today's material are my thoughts on your questions designed for educational purposes, increasing investing performance and options knowledge. Any stocks or options discussed today should not be taken as direct trading suggestions. The discussion of the strategies, maybe when to use them, maybe how to use them, including buying calls on the VIX just for hedging a portfolio, not for potentially trying to profit in one direction or the other. Those should not be taken. I'm not trading URI anytime soon that we looked at in the bull put credit spreads and how those performed, or Sherwin-Williams, how those performed. Just examples that we pulled out directly from the search to see how they perform, to visual interpretation of what to expect with a 5-day trade, 4-day trade, why trying to trade a Monday bull put credit spread and closing it on Tuesday, you might only get 4 or 5 cents of profit. You can't expect the annualized full return on that because you can't do it every day. It doesn't go to zero every day, except for maybe in the case of SPY when you have Monday, Wednesday, and Friday expirations. In any case, options involve risk, may not be suitable for all investors. Right? Saw a lot of the tools today. We saw the search tool. We saw the back testing tool. We saw the stock repair tool, very important. We saw the stock insurance tool, very important. So you can take advantage of all of those tools for 14 days, no credit card required. Just go to poweropt.com, first name, last name, email, address, and you can have full access for 14 days, including access to the historical tools with about 3 months of available data. Subscriptions start at $45 after the 14-day free trial. We do offer other levels of service for even real-time and the premium includes the real-time plus full access to all the historical data, which goes back about 10 years. I showed you where the webinars page was, powerup.com/webinars.asp. It's a free page. You can scroll through that at any time. You can also check out our blog, blog.powerup.com. Many of our videos are also posted on YouTube, and you can comment on the videos on YouTube as well. So you can always check us out there under Power Options. All right. Well, I didn't see any last-minute question comes in. Martin says, thank you, Martin, for your time and for your questions. Thank you all for joining me this afternoon for your questions, and as always, for your commentary and assistance in answering the questions that came in and offering other ideas, suggestions, hedging ideas, and more. If you think of a question later on this weekend, just go ahead and send me an email at any time to support@powerup.com or support@radioactivetrading.com. Remember, you can also call us during market hours at 877-992-7971 or at 302-992-7971. Remember, trial members and subscribers, schedule a coaching session at any time. It's that 35 to 45-minute phone conversation with myself or Ernie. We'll walk you through the tools on the site and answer any questions that you have. All right, ladies and gentlemen, have a fantastic weekend. Get some rest. We'll see what the last week of October 2019 has for us in the markets. And get ready for our last 2 months of trading shortly after that. I'll see you next week. Take care now.